Hello, good afternoon, everyone, and thanks for joining us. There's been a huge amount of noise, speculation and uncertainty around the Supreme Court judgment and the FCA's proposed redress scheme, and we know that not everybody here will have had the time to follow every twist and turn. Today is about clarity, context and practical guidance. We brought together a panel who've been directly involved at every stage, from the court process itself through to the operational and the consumer implications of the FCA's consultation. I'd like to introduce the panel. Jonathan Kirk, KC from Gough Square. Rachael Jones, Director of Automotive Finance, Autotrader. Shaun Harris, Commercial Director of Cox Automotive, and Paul Bentley, Finance Expert with the National Franchise Dealers Association. So let's begin. It's important that we get everybody today onto the same page, and Jonathan here has been central to the work around the Supreme Court case. And he's going to open by explaining exactly what happened, what the ruling means, and why it matters. So over to you, Jonathan.
I think this is working. There we go. We'll see. So where were we? We were all last July thinking that the worst had arrived. You had all been accepting bribes for 100 years. You're all criminals, really, crooks. And so the Supreme Court heard a case where we made the brilliant submission that motor dealers and brokers are not crooks. In fact, this is not a fiduciary relationship, and we won. So we'd like to say on behalf of the NFDA, it was the NFDA what won it. But I'm asked to give you a little bit of background to it so that we can remind ourselves where we were then and where we are now and what that means for the redress scheme. So, Supreme Court gave judgment on the 1st of August, Friday the 1st of August, in the summer this year. A very unusual time to give a judgment. They wait until the markets had closed because they knew what it meant. The case name was First Rand Bank and Johnson, but there were other appellants. They don't matter for the purposes of this. So what did it mean? It basically meant that the tort of bribery, so that's the civil, effectively a civil crime of bribery, didn't apply, won't apply, and there is no such thing as a breach of fiduciary duty now in relation to brokers and dealers. So it was very important from that perspective. But let's just remind ourselves of the Johnson case, because the Johnson case has a resonance going forward. So Johnson was a factory supervisor who purchased his first car at 27. He got a quote online. He went to a dealer in Cardiff, found a Suzuki. Was turned down for finance because his income was only £13,200 a year. He borrowed £4,500 under the hire purchase arrangement, £1,595 as a personal loan because the car wasn't worth as much as he was lending. The commission paid to the broker was an eye-watering £1,650. It wasn't mentioned, and this was a discretionary interest rate commission scheme between 8 and 13, but he did get 8%. And so the allegation was that that was a bribe. We also said that the dealer was in a fiduciary relationship, so there was a breach of that fiduciary relationship. The Supreme Court rejected that on the basis that consumers, dealers and lenders had at all times been pursuing their own commercial objectives, and the key phrase was an offer to find the best deal is not the same as an offer to act altruistically, selfishly. So the Supreme Court came to the brilliant conclusion that when you go to buy a car from a motor dealer, they're not looking after you like a trustee or a solicitor. Absolute genius. So that meant that bribery and the claims about dishonest assistance all go. But what didn't go, and this is what remains important for going forward for the redress scheme, was the claim that Mr. Johnson made that there had been an unfair relationship. So for those of you who don't know, unfair relationships is a statutory claim under the Consumer Credit Act, and it basically asks you to look at all the circumstances and decide in a very careful legal way, is it unfair? Is it unfair? So that's basically it. And they decided that in Mr. Johnson's case, given that they hadn't disclosed commission that was such a high proportion of the amount, not so much the amount loaned, but the cost of the credit, that it was an unfair relationship. That was, not a surprising conclusion, a conclusion that everybody kind of knew. It was a bit of a shame that Johnson was the case that ended up there on appeal, but that's another story. But what the Supreme Court said is that the high level of a commission is a powerful indicator of unfairness, and it adopted what the FCA had said were a list of factors that might be relevant, which are the size of commission relative to the charge for credit. That to me seems to be a little unfair, because if you offer a car and you've got a very, very low interest rate, the amount of credit that people get is quite low. So you can give people a really good deal in the APR, and the amount of commission by proportion will be higher. But that's what they came to. The nature of the commission was a factor, because discretionary commission may create incentives. As we all know, discretionary commission arrangements are gone. The characteristics of the consumer, the extent and manner of this disclosure and compliance with the regulatory rules. So what we left with in summary, we don't need to worry about bribery. We don't need to worry about breach of fiduciary duty. The lenders need to worry about unfair relationships, because it's only a claim as between a borrower and a lender, and brokers and dealers need to worry about it from the court perspective, putting aside the redress scheme in relation to direct claims, in relation to breach of FCA rules and potentially indemnities. And that's a kind of very short summary of where we got to last time. But as we all remember, it was the NFDA what won it.
Another clap, I think. Thanks, Jonathan. So with that foundation in place, the natural next step is to look at what the FCA is proposing. A lot of people have heard phrases like industry-wide redress and compensatory interest, but haven't yet unpacked what any of that really means in practice, especially for dealerships. Paul at the NFDA has been working closely on the consultation, and he's going to take us through the headline points. Now, Paul, would you like to stand there? I'll come and swap places.
This is, as Jonathan said, this is a mass redress approach that the FCA are looking at. They've not done many in the past, only 2 before. I think it's one of those, it's not going to go away. It's not something that we're going to talk our way out of. I think it's something that we need to embrace as it's probably not a bad thing that all these claims covering 14 million different agreements across that period of 2007 to 2024, that this is going to, their intention is to try and get this done and dealt with in one foul swoop. The worry is that they're rushing at this, and so you'll know that the original closing date of the consultation was the 18th of November. The NFDA, along with other trade bodies and firms, challenged them on this, and they pushed it back to the 12th of December. So that's still only 9 weeks. Typically for these mass redress, it's 12 weeks. And so we still have got a lot of work to do in a short period of time. I think the key takeaways are what are they trying to find out? Who is it impacting? So it's anybody with a regulated agreement from 2007 to 2024 that had a deal that had a DCA or discretionary commission, that had a high commission in their view is a 35% of the charges or 10% of the loan, always in a tied relationship. And these are all very controversial areas because they picked elements of the Johnson case and have looped it in. And I think their aim is to try and make sure that there's no cases fall outside it, and therefore there's no secondary litigation that can take place. So I understand what the FCA are trying to do, and they have been engaging with the trade bodies and the lenders. There's lots of dialogue. The F&I working group, the heroes behind the scenes, really do a lot of work on behalf of the NFDA, and we are going to go back on their behalf, the members' behalf, with a very well produced and evidenced set of rebuttals to say exactly why we think their thinking is flawed. I think the key is that we know it's not going to go away. We know it's probably in the round the right thing to do. We just need to make sure that whatever they decide to do in February that they launch is fit for purpose and rewards the right customers, and it's not just a windfall for customers that have probably had a good deal in the first place, but suddenly are, because the likes of Martin Lewis, et cetera, have said, look, there's a redress on the cards, get your complaints in. Unfortunately, some customers have had a good deal that have had no complaints might just get rewarded with a compensation. That's not the aim of the FCA. The FCA is to try and identify where there was an unfair relationship, and that in itself needs challenging, and just to make sure that the people that had genuinely lost out are the ones that are compensated. That's probably a whistle-stop tour of what the consultation is trying to cover.
Great, thanks then. That's given us the framework of the FCA consultation process, but the other side of the whole issue is the operational reality, the pace, the volume of work, and what both lenders and retailers may be expected to deliver if the scheme goes ahead as drafted. Rachael is now going to set out what those timelines look like and what pressures sit behind them. And then I'll bring in Paul and Shaun to reflect on what they're seeing amongst retailers and what preparation actually needs to happen next. So Rachael, would you like to?
Yeah. I'll just stay here maybe. Hi everyone. I think lenders are working incredibly hard at the moment. We work up with obviously a lot of lenders at Autotrader, and there is a huge amount of work going on, not only for inputting into the consultation and gathering evidence to feed into that, but also preparing for what is to come next year, whether that be initially identifying those consumers who are in scope, and that's obviously going all the way back to 2007. That is incredibly challenging to try and do that job. So they're busy doing that. They're busy working out how operationally they might run the scheme through systems, how they might communicate to consumers, how they might actually do the process of the payout, et cetera, and also starting to put together the governance process around bringing this to life as well. So operationally, it's a colossal effort being put in at the moment, and the timings are certainly tight. So the redress scheme is, from what the FCA have said, they said that's going to be finalised at the start of next year. They said the final rules policy statement will come out in February and March time, 2026. But the scheme will launch immediately. And so that means that lenders need to be ready for then. They need to contact consumers within those first 3 months to identify them. So it's, right now, obviously, we don't know what the final rules are, what the exact final scope is, et cetera. So it's a huge amount of pressure on the industry to get ready for that. And we'll find out in next year what that looks like, I think.
Yeah. Paul, what are you seeing from the retail side of view? What are you seeing retailers tell you?
Sorry, I can't hear you.
Sorry, what are you seeing retailer levels of readiness?
It's difficult to get ready for something that you don't know the outcome of. I think the key is that, and one of the things that we was going to try and cover today was really just to make sure that you're helping yourself the best you can, understanding what schemes were in place during that period. there's still some argument whether it will go back as far as 2007. That the rules from the FCA came in 2014. That period before sits under the OFT and potentially still needs agreeing by the Treasury whether they can go ahead and do that. So it's really difficult for retailers to start getting into that detail. There's another realistic, real-world element we need to consider, which is there's lots of retailers that have grown by acquisition. There's lots of taken businesses over. And when you buy that, whilst you might have great processes in place, the ones that you're buying might not be as strong as the ones you're bringing them into. So getting that paperwork together will be a challenge. And that's one of the points we're raising with the FCA, which is realistically under GDPR, you're limited to how long you can keep the paperwork, yet we're being expected to go back. And more importantly, if you can't supply the paperwork, you're guilty. And so it is a difficult one, but what I would say is check the contracts you had in place, check the versions of your IDDs and what you had in place, and realistically just try and get yourself on the front foot. When these complaints land, and they will land early next year, as a dealer network, we need to make sure we're as ready as we can be for it. And that means having access to the paperwork that you can get, access to the documentation that you can get your hands on. Looking at the contracts, did you actually have a DIC scheme in place at that time? What were the rates you were charging out through your typical campaigns? Did you have any tied or first refusal relationships? These are all things that you can go away today and start trying to paint a picture of exactly what you were doing at those different stages. The lenders will absolutely come to you and ask you for more information and more paperwork. But at least if you can get that scene set before you start that's going to be, I think, a couple of goals start on where you need to be.
Great, thank you. Another important piece of the puzzle is how customers have responded to the increased transparency already in place. And there's been a huge amount of speculation about what Commission disclosure might do to volumes or conversion. But the real-world data is telling quite a different story. Shaun is going to take us through what that data means and what that data is showing, and talk about what consumers genuinely care about, with contributions from Rachael and Paul.
Yeah, I think the data shown us that customers are absolutely, they're fine. If you go back to last October, there was a number of lenders that stopped taking loans on the Friday when the judgment came out. They put in place the processes of existence, nature, and amount. A lot of them were lending again the following week, and we were looking at the data, and the needle didn't move. And I think yesterday was the September announcements from the FLA, and new car lending September 25 to 26 was up. Used car lending September 25 to 26 was up, I think 7% and 5% respectively, if I remember right. And if you keep on top of the sentiment, I know there's lots of retailers out there that are on Facebook groups and various things, and the feedback's been actually the customers, they took on board the transparency, they quite liked it, but they're taking motor finance and volumes that they were taking it before. We do seem to have been insulated from the effects of customers seeing it as a big bad industry, because actually automotive retailers and lenders do a really good job of lending money to allow people to buy cars. I was lucky enough to hear some research of what the landscape looks like in Europe, and when you see how retailers and consumers look at motor finance in Europe against the UK, we're actually doing a really good job. There's a reason why more than 9 out of 10 consumers use finance to buy a new car. That's because the products they're getting are really good.
I think we've got to be thankful. My mic up. I think we've got to be thankful as well for these PCP and HP enable people to buy new cars, enable stock to turn, because it grants them access to vehicles, doesn't it? It's the whole opportunity that finance gives them, and it's certainly kind of in the FLA stats, from what we see in terms of people engaging with finance on our platform, there's been absolutely no drop-off. Even when, you know, Martin Lewis goes live on kind of his site, there's no sudden drop-off in interest in motor finance currently. We're not seeing that in sales either. So it just shows how important these products are to the motor industry, to enable people to buy better cars as well, quite often as well.
And it's never been more transparent. You guys play a huge part of that. In any one given day, there's hundreds of thousands of vehicles on Autotrader with real, clear, transparent finance offers. The industry has never been more transparent. I think you're probably looking at 90% of search media would have a clear and transparent finance offer. So consumers are, you know, well educated.
Paul, anything to add to that, Paul?
Yeah, no, I think transparency is key. I think if you think of that customer journey, they've got more access to the information. They can find out which car they want to buy, where they want to buy it, what rates they can get on what products, how much their car is worth, what their settlement is. Now, customers hold all that information. I think the motor sector's evolved to complement that buying process rather than to sell. And you're absolutely right. You know, I think the effort that goes into making sure that customer journey is compliant should be the gold standard for many sectors. You know, I don't think the same level of attention to detail and the same focus around that customer-centric outcome can be witnessed in a lot of lending sectors. So, yeah, transparency, I think, has always been key. And I think we're seeing this. I do think we'll continue to see this as we go through it. Actually, the argument still has to be answered, which is just because these weren't disclosed doesn't immediately assume harm. And we shouldn't lose that in the detail during this consultation.
Great, thank you. So we've had the Supreme Court piece, the FCA's proposals, and gained some good insights into the impact or non-impact on consumer behaviour. But let's try and bring this all together into practical actions and messages that dealers can actually take away. What does transparency mean in day-to-day practice, and how to engage with the consultation, and what behaviours now carry the greatest risk? I'm going to ask each of our panellists to share the key takeaways they believe retailers need to leave this room with. And Jonathan, I'm going to start with you. What are your key takeaways?
So the first takeaway is that consumers do not care where the money's going to. They don't care. They care about what the bottom line is. They need to know usually what the monthly amount is on a PCP, but they really don't care where it's going to. So you might as well be transparent about it, because it doesn't make any difference, which kind of gives the lie to the scheme. Second point, if this scheme, and we hope it won't take effect in the way it is taking effect at the moment, if this scheme goes ahead, fortunately, brokers are not going to be directly liable, but they will be. You're all authorised, so you will have a duty to help the lenders. Now, I think if the timeline for that help goes through, so you have to provide the information to lenders within 4 to 6 weeks, the number of claims is going to be overwhelming for you, and so we need to, and I know the NFDA is pushing back against that, but you're going to have systems in place in relation to that. And then the final point I'd make is that the compensation that has been proposed by the FCA seems to have been, this is how much the economy can take, X billion, and we're going to devise a fairly convoluted, complex scheme where you take 2 different methods, you put them together, and then you divide by 2, and then you go, yeah, with that. And it seems to be designed not on the basis that it should be, which is what has the consumer lost? The consumer has lost, if the scheme is truly bad, they've lost what they could have got it for if they'd got the market rate. And that was an argument that was advanced in the High Court in the Arnold Clark case. And my view has always been about this, that if you have got, if you've paid 20% APR and you could have got it for 10% APR, then your loss is 10%. It's not what the FCA have come back with. And that's my strong view, because if you couldn't get it cheaper, then you haven't lost anything. And I think that's, I know that everybody is pushing back in relation to the way in which they've calculated it. So those are my 3 takeaways.
Rachel?
I think I'd look from the consumer angle in terms of that thread around transparency. We did a survey to consumers just as this whole investigation was announced at the beginning of 2024, and asked consumers, you know, has this affected your trust in buying a car on finance? To which they said, yes, it has dropped. You know, my level of trust has dropped, although they still obviously are continuing to buy it because they need finance. But in order to build that trust, we said, what kind of things would help build trust in buying a car on finance? The top thing they came out with was saying a declaration from the selling retailer that there are no hidden fees, which is an obvious one. But actually stating the obvious sometimes, you know, is a really good thing for consumers. And the second one they said was having a choice, feeling like they had a choice of finance, whether that's through product or through lenders, in whatever way that is. We know as a marketplace, you know, if a consumer is provided with choice, they feel informed and have the comfort of thinking through the options that they have to then be able to make a decision. And so those were the kind of key things that came up, and you know, being transparent about that, providing that information to the consumer, I think is really important.
Shaun?
Yeah, I think if you look at the business model as an industry, as retailers, we had in the days going back to 2007 and the later years, there was no reliance on finance and insurance to eke out the maximum we could to make an all-round profit. And our business model probably wasn't quite right. We probably should have had more margin in the metal and less reliance. And you know, if this has done one thing, it's probably taken us to that place. I do feel aggrieved, though, for retailers and for lenders, that this feels very much like, I used an analogy, this feels very much like we had a 30-mile-an-hour speed limit on a road, it's been changed to 20, and everybody that drove over 20 when it was a 30 is now being fined. And I think, you know, retailers have got to try and help their lenders to, you know, I know it's going to be difficult, it's 2007, but try and produce that information to try and take out as many of those, you know, over 20-mile-an-hour ones as we can, because, you know, rightly so, we're looking at a judgment that was made on an unfair case. It's not going to be easy, but I think you know, the other takeaway would be they've been doing a great job since last October. Just keep doing it, be transparent. It clearly hasn't affected the consumer's usage of what is a valuable product to them to buy cars.
Paul from NFDA.
Yeah, I think there's 2 elements. The NFDA, obviously, on behalf of the members, went through the Supreme Court process. The outcome from the judge contained a lot of the NFDA case, so I think it was absolutely the right thing to do. I think now the next step is 2 elements. One, what the dealers and the lenders need to do and be prepared for. The second bit is really how the NFDA and the F&I working group and its members put the best foot forward on the consultation to make sure that we're not just coming across as moaning for the sake of moaning. We're saying these are fundamental flaws in the methodology, the calculations, the approach, and ultimately potentially rewarding the wrong people. We've got to make sure that we can concisely argue and rebut these points and have the evidence to back it up. So, you know, there's a huge task ahead. We are continuing to push back to try and extend it further. Hopefully what the FCA will do is listen. That's all we can ask. And I think we can put compelling arguments across in the areas we need to. So, yeah.
Brilliant. Okay. Before I open the floor to questions, just want to address one hot topic, claims management companies. There's been an awful lot of confusion, misleading messages and uncertainty around that. Shaun, you've looked into this, and can you just report what the messaging really is?
I just think it's... I have to be careful not to swear when talking about claims management. I'll try and keep it professional. Again, it's parasitic behaviour, and a lot of these companies are lead hoovering with blatant lies and misrepresentations. There was a classic one that saw 99% of all loans are affected. Well, more than 1% of all car loans are subsidised, so they can't be affected. We've got captives that aren't affected that are more than 5% of the market share. So, you know, Ian and Paul were talking the other day, there's been, I think you said, hundreds of claims upheld against claims management companies. Some of these are supposed to be FCA regulated as well. I just think the FCA and the government need to take a far, far harder stance on them.
I think the FCA are trying to head them off at the pass. You know, they've spent £1 million trying to educate consumers to actually, they're trying to put a process in place that makes sure it's easy, transparent for the customers to do directly rather than having to go through these claims management companies. But unfortunately, we are where we are. There's lots of misrepresentation cases being upheld at the moment. I think the last count was 225. I think there were 73 law firms being investigated for the style and the marketing that they're doing on these. So I think we all have got a duty to make sure that the customers understand that when this redress lands, and if we can help them, we make sure it's in the best form it can be, that they can deal direct with the lenders. They don't need to give 30% of the claim away to a claims management company. Lots of overseas investment coming in to fund this, so it's not going to go away quietly. But ultimately, they looked at PPI, they saw that was a lovely little nest egg, and they've tried to do the same on this. But as I say, hands up to the FCA, they are trying and push this back and educate people that you don't need it.
Jonathan.
Just one point which amused me greatly, and some quite good news, is that there have been set up quite recently some new CMCs, and the target of these new CMCs are victims of CMCs. And so basically, if you've been the victim of a CMC, you can go to a CMC to pursue that CMC, which struck me as being, you know, what you reap, what you sow. Yeah.
Okay, I'm going to open the session up to questions.
Good afternoon, panel. Paul Bennett from Maddox Square. Question for you. In the three areas that the FCA has created, DCA, High Commission, and tied or exclusive arrangements, whilst the bulk of this relates to used vehicle financing, potentially could a captive be pulled into this on new vehicle financing because their franchisee was promoting a tied and exclusive, albeit subvented offer?
Yes, is my view. Yeah, a simple answer. Potentially.
Yeah, I'm trying to understand the question. Yes, they can be pulled in, Paul. I think ultimately, I still take a step back and say what was the actual harm. There's an argument to say if you go into X brand dealership and you see X brand paperwork and everything in that showroom is branded X, there's an acceptable assumption that is a tied relationship, but we do need to follow this through, that just because they didn't disclose that there was a tied relationship, there was any harm.
I understand that. It was really more from the legal perspective, if it could happen.
Yeah, I think it could, on the current scheme as it's drafted. But we'll see. Yeah.
Hi there, panel. You'll be safe, Paul. I'm not asking you a question. So I have a question about judicial review. What's your thoughts? Straight to you, Jonathan.
So when you say question about judicial review, well, my clerk's here actually, so he'd be very interested. But the you mean the judicial review involving Arnold Clark?
No, what's the potential for this to become a judicial?
I would be absolutely astonished if there was not a judicial review of this scheme. I think in the current form that it is, I mean, there are so many practical difficulties, it's hard to see that that wouldn't be irrational. The calculation of, this is supposed to be compensatory. It's so complex and it doesn't have any kind of rational basis that I think it's inevitable, and I know that the lenders are gearing up, and I don't want to say too much, but I would be, if it stays as it is, it will be the subject of a judicial review, I'm sure. I don't think it's going to stay as it is. All the soundings we're getting is that there is a lot of pressure being placed on the FCA, and this is a bit of a cock-up, really.
And then just as a follow-up question to that, do you think there'll be a delay then in terms of any rule that is imposed? Would they have to?
So with any judicial review, you've got to bring it promptly and in any event within 3 months. The FCA have responded to all of the court litigation by deferring and delaying. So they responded to both the Arnold Clark judicial review and to the Johnson case by delaying and waiting and waiting. They were involved in all of these cases. So in my view, if there is a judicial review, there'll be a permission stage, first of all. In this kind of thing, you would expect to get permission. It will be dealt with quickly, but I would anticipate they would delay. It will depend upon what the scheme looks like at the end, and you can imagine there are lots and lots of lawyers working on submissions as we speak, and there is going to be a lot for them to work through. So I wouldn't anticipate that there would be, definitely a scheme up and running by March, April of next year. I think that's optimistic, unless, of course, they come up with something that is very favourable to the industry, in which case there'll be a judicial review by the claimants. And so I think you will find, by hook or by crook, the lawyers will be involved at some point, which is always a good thing, isn't it?
A few more last questions. Anyone? Just like to actually, Paul, what do you think will be the impact on the industry if there is a judicial review?
We've obviously asked for an extension to the consultation. We've gone back and asked for another, with the sole purpose of trying to point out that the methodology is flawed. The sector itself has proved over the years it's very agile. It adjusts to every hazard in the road. As we alluded to earlier, I don't think there's a more transparent sector out there. And so long as the lenders are still around, the dealers can hold off on this, and the outcome of this consultation doesn't impact that too much because of the money that's going to be taken out of the sector. I can see it just continuing to evolve the way it has. I think, the FCA, we've worked, I say we, the dealers, we've worked to the rules that have been in place that the FCA have had in there. Nobody's gone out not to do the right things. Number of us, including myself in a previous life, had heavy investigations by the FCA where they looked into all the processes. There's been lots of dialogue with the NFDA and its members with the FCA. And all these points have been multiple opportunities for the regulator to say, I don't like this. That's never come about. So that sort of tells you that what's being done at a point in time is above what their expectations are. So I don't see any different. I think it'll carry on being a very transparent, enabling experience for the customer. I think customers see it as a must-do when they're walking into the showroom. It's a necessity. They need a car. They walk out having had a great experience and love to show off their car and brag about the experience they've had. So now I'm supremely proud of the the motor sector, and I think this won't do them too much damage so long as it's handled right by the FCA, the regulator.
Okay. Shaun, last word. Last word, Shaun?
Yeah, I think it's a tricky one for the government when you think about this as well. We need to find economic growth from somewhere, and we're a service economy. And you can see there's a couple of major banks that are international players that are applying pressure. The very fact that one postponed its results. So I think the government's in an interesting place in that they need these financial institutions to see the UK as a safe place to invest. And it doesn't look that way at the moment. And I think we need, to Paul's point, this needs to get done, dusted, put away. we need to get confidence back in the economy, get these lenders engaged, get them spending money again, and move the economy forward, because it doesn't do us any good to have a stagnant economy and uncertainty.
Well, there you have it. One of the most insightful 2025 panels, I think. It's all still a question mark, but I hope that this panel's given you the clarity, confidence, and a few insights about how it may proceed. But we'll meet again next year, and we'll monitor what did happen and maybe what's still to happen. Thank you so much. Thank you.